Hello, everybody. If you're just joining us, we're just going to wait for a few more people to join. This is the first webinar we've ever tried, and I can already tell you I don't like it because I can't see you, and I don't get to hear the jokes and the banter from you, and I don't get to hear Riley and Ted asking interesting questions. But in any event, I think we'll go ahead and get started. This is the halftime report that we like to do pretty much at the half point of the year, usually around the end of July. Obviously, it's the 1st of August now. We like to do a report at the beginning of the year, and we like to do a report at the halftime. And so I think this is going to be an interesting halftime because this has been a very interesting year so far. First things first, let's see if this is going to work. There we go. Questions. If you sort of hover at the bottom of your screen with your mouse, you'll see that there's a question and answer area there, a place to ask questions. So you can just type your questions in, and then when we get to the end, I'll do my best to answer those. We're looking at probably maybe 30-40 minutes of the seminar itself and the webinar itself, and then after that we'll go to the questions. I already have one, so that's kind of exciting. And I've got just a place to put it. Just for full disclosure, I am a registered representative and an investment advisor representative with Voya. All of our securities go through Voya. Magellan Planning Group is the financial arm of a sort of a three-headed monster here that we have. We have a legal team. In full disclosure, I am also an attorney, but we have a legal team, a financial team, and a tax team. And Henry Spill heads up the tax team. Lynn Bitter heads up the law firm, and we see somebody's already raised their hand. Martin, you're going to have to just wait for a second. And then all of our securities go through Voya. So Voya doesn't have anything to do with the legal side or the tax side, so those things are kind of separated. But we do coordinate behind the scenes for your benefit, and it's something that we've been doing for 25 years now, and we're pretty proud of it. So we'll keep going. Let's talk about now today's agenda. We're going to talk about what happened in the first half with the markets. It was obviously dramatic. We're going to talk about some of the fundamentals that went behind that. The Fed had a lot to do with it, as we all know. We're also going to talk about what we look for maybe in the second half. I hope it's going to be better. I think we are all looking for better news, especially when it comes to the virus. So let's look at the first half of the U.S. markets. Obviously, it was turmoil. You can see now on January 15th, the U.S. and China signed that phase 1 of the trade deal. And then the market started heading up. We had sort of a good solid couple of months there. And then we all know what happened after that. The virus got out. It got out of China, got into Korea, went to Italy, went to Spain, hit Oregon, Seattle, made its way to New York City, devastated New York City. And then, of course, now the rest of the country is dealing with the fallout too. March 12th, Trump institutes the travel ban to Europe. On March 16th, Trump says COVID-19 could extend into August. We know that is true. It bottomed out right about there. And then the Fed did some things that we're going to talk about here, which I think is what really caused the turnaround there. And then so we have some clinical trials that seem to be working well. I know that we're actually in some phase 3 trials now with 2 or 3 vaccines here, and I think also maybe 1 or 2 over in Europe. The Fed, again, jumped in and they did all kinds of stuff. We're going to talk about that. And then, of course, you know, the economy started reopening slowly. Georgia was one of the first to reopen. I was glad for that because I really needed to get a haircut. And I love these restaurants around here, and I sure miss them. And then, of course, June 10th, it looked like there was going to be a sort of another COVID-19 scare, and then the Dow dropped 1,800 points. So it's been a wild ride. And if you look at the totality of what happened in the first 6 months, you can see almost an entire market cycle in 6 months. And if you look at where we are today, we're back up to almost 3,300. So we're almost exactly where we were when we started this year. It's been crazy. And there's going to be a lot of fallout, I'm afraid, still that we have to deal with. Every year, different media outlets ask all of these financial groups what their target's going to be. What do you think the forecast will be sort of at the end of the year of 2020? And this is what these guys said, and they're all pretty right on. If you look at the group average is right about exactly where we are today. And so you have to ask yourself, okay, well, what's going to happen for the second half? I mean, I don't know that these guys ever were thinking about the virus. I know that I certainly wasn't thinking about the virus. I wrote a letter called the 6 Signs of, 6 Signs of Peril, that came out in December, right around Christmas. And I listed several things in that letter about problems that we see coming up. But one of those things was not the virus. So luckily we were already kind of positioned for a major drop, and I think that helped. The Fed stepped in again and sort of saved the day. So that's why, for a large extent, that's why we're back to where we are. So let's just look and see, what actually went on behind the scenes. We know what happened with the virus. Let's take a look at some of the financial indicators. Now, this is going back to January 2010. Okay, January 2010, remember, we had just come out of, and we're coming out of the Great Recession of 2008. And the Fed had stepped in and had done a lot of stuff then. And you can see that pretty much all of our indicators are green. Corporate profits look great. Disposable income looks good. Credit availability, remember, that was one of our yellow issues, because you remember back then the banks had lost so much money in these mortgages that had collapsed that they just basically didn't want to loan any more money out. The banks were flush with cash, but they didn't want to go through the loan process. So credit was a little tight then. Remember, gas was also more expensive back in those days. And we've always had volatility. So that's just sort of, when you get to this large a number, Dow 30,000 or Dow 26,000, the changes are going to be more dramatic, obviously, because the numbers are larger. This is going on now to January 2020. This is before really the virus took hold of the economy. And you can see that most things are, well, some things are green, about half is green, about half is yellow. And I think that goes back to a lot of the stuff that I was talking about in my letter back in those days, 6 Signs of Peril. Obviously, the political environment was negative and the geopolitical risk was negative. But I'll be honest with you, I don't think that's ever been positive, yellow at best. So let's go on now to right after the virus hit, June, the end of June. You can see that we have a lot more red on the screen, a lot more yellow on the screen, and not only just a few greens there. Monetary policy was positive, interest rates positive because we're back down to zero. Fiscal policy, inflation, we'll talk more about inflation in a second, but obviously equity market valuation is negative, geopolitical risk, well, that's negative. Political environment, negative. International economic outlook, negative. Corporate profit growth, negative. And all of that, most of that had to do, well, there were underlying problems, but a lot of it had to do, obviously, when the virus hit, instigated a lot of that. So that's the virus, and we know that this is really the impetus to create the drop that we had. I don't think there's anyone in America today that hasn't been affected by this in some measure. We've had one of our employees caught the virus. She's recovered now. Most of our staff is working from home. We came back about June 1st. We tried that a couple of weeks, maybe a month, and then one of our staff got it. And so we've had a couple of clients catch it. Everyone has recovered so far, so no deaths, thank God. But obviously the market dropped a good bit, and obviously people are at home and they're ready to get out, I can guarantee you, and go back to their favorite restaurants. Now, here's what the Fed did, and this is a large part of why we're back up to where we are today. The first thing they did in March 15th is they cut Fed rates back down to zero. Remember, we were at zero after 2008, and then they were gradually raising it, and when we get up to like 3.5, 3.75, something like that, and then now we're back down to zero. So that's where that is. Quantitative easing. So 700 billion, remember that was originally the TARP. That was the original TARP package, and we've done a lot more than the TARP this year so far. Quantitative easing just basically means, when they say asset purchases, what assets are they talking about? They're talking about treasuries. Well, Where do these treasuries come from? Well, they come from the Department of Treasury. The Treasury makes up these treasuries. It used to be paper, now it's just electronic. And then they sell those to the Fed. And the Fed buys these assets, and what do they buy them with? Well, they buy them with dollars. Where do they get those dollars? Well, they just make them up. And again, they used to make them, print them in paper, but now they're made with just electronic. So the Treasury comes up with electronic treasuries, and the Fed comes up with electronic money, and they swap that, and then the checks that you get from Social Security are coming from that money. The PPP came from that money. All of the stimulus, all the quantitative easing that we get comes from that money that they just create out of nothing. And you know, if you do that little by little, it's not a big problem. But over time, if you do a whole lot of it, it can become a problem. And that's something that we're going to have to really watch. On March 17th, they created the commercial paper funding. What is commercial paper? Well, commercial paper is essentially IOUs or loans between companies and banks. They're usually pretty short term. And they're usually pretty, for most corporations that have good credit, it's usually a pretty good bet. They created a money market mutual fund liquidity facility. Remember back in 2008, maybe you do, the money market actually broke the buck. Remember that? And that was when $1 in a money market wasn't worth $1 anymore. And a lot of the money market is backed up by commercial paper. And so that was another important thing that they did, was to shore up money markets, because we didn't want that to happen again. And then support credit to large businesses and liquidity for outstanding bonds. Well, remember, if I go back to my letter that I wrote, one of the things on there that I was looking at, number one, investment grade corporate bond maturities and possible downgrades. Well, that's happened in a huge, huge way. And so guess what? The Fed now has started buying them up. The government's buying them up. April 6th, created the PPP program. We used that here, and we didn't have to lay anyone off, and we were very fortunate. And there are a lot of companies that I see that are closing their doors, some of them possibly going out of business forever. We've seen a lot of bankruptcies, Chapter 11s, and full liquidation. So I just read an article yesterday that's probably going to increase. And then the Main Street lending facility, that's just, you know, kind of everybody, you know, that needs to come in here and get a loan. We're just trying to prop up the economy until this is over, until we either get a vaccine or no one's immune, or everyone's immune, or whatever. Someone sent a question in earlier, and I wanted to pop it in here because it comes from Tom Vincent. Tom asks, what will the consequences be of all this massive federal debt? There is no political will to address this, but there have been no obvious negative effects yet. And he underlines yet. And I think that's the right thing to do, because yes, you're right. It is hard to see that there have been negative effects from all our debt. One negative effect from our debt would be that you have to pay interest on the debt, right? And so you have a whole lot of debt, you got to pay a whole lot of interest. Well, I wanted to stop here because if our Fed rate now is 0 and we're going to be able to issue treasuries that pay practically 0, how much debt can you take on? Well, if you go negative, if you have negative rates, then it's almost like you're getting paid to take on debt. So the question is, you know, I don't know the answer to that. I don't know what the outcome is going to be. If you look at Japan now has 200% GDP, debt to GDP, and they've had that for a while. We are right about 100% of debt to GDP, and that's probably going to go up to about 120, maybe 130% debt to GDP before this is over. But so far, you're right. Nothing, no obvious negative effects yet. And I'm one of those people that's obviously very concerned about it, because at some point, I mean, we have to be honest with ourselves. We're never going to pay it back. I mean, you're not going to pay the back. You know, what countries do when they have lots of debt is they inflate themselves out of it. They just keep printing money, keep printing money until eventually that money dies, and then they replace it with something else. So the end result of all of this debt and unlimited debt is going to be, I'm afraid, the collapse of our money at some point, unless something else is done. And you know, I've had some questions from people that have said that they heard on the internet or on Facebook that the dollar was going away. Well, it's not imminent. Okay, what's happened is the Bank of International Settlements in Switzerland, in Basel, Switzerland, sent out a questionnaire in 2018 to all the central banks, pretty much in Europe and the United States and in the Americas, and they asked them, how would you feel about a no paper money, just using like a Bitcoin type of thing, but like a Fed coin is what they're calling it. So I think that eventually we will be moving to purely electronic money. And I think that's not imminent right now, but I think that's something that's coming. They've already been talking about Fed coin. And so Fed coin is what the dollar would be. It would just be kind of like Bitcoin. And they're getting better with the technology. And the negative thing to this, I think, is, everyone's going to be seeing everything that you spend your money on. The government will know everywhere you spend your money on. And get this, if we go to negative interest rates and you've got your money literally electronically in the Bank of America, wherever it is, and they impose negative interest rates, it's not like you can withdraw your money and take it and put it in a safe. You're stuck in this electronic world. And so you're going to be paying negative interest rates or earning negative interest rates, right? Which means paying rates. You're going to be paying rates on money that you can't withdraw, you can't move, you can't do anything with it. Not only that, inflation, you can't hide from inflation there. So, and you're not gonna be able to hide from taxation and those other things. They've in Europe and in Italy, and I remember back in Cyprus a few years ago, they basically had a buy-in. So instead of the banks getting bailed out by the Fed, the depositors bailed out the bank. And they just lost maybe 30% or 50% of their deposits there. And a lot of that was directed toward, a lot of the Russians that were hiding money offshore. But it's a concern. Here's what the assets of the Fed are now. Back before this 2008 thing happened, we were less than $1 trillion. And it sounds like terrible. It was about 800 billion, really. And then that hit, and then there's the TARP, and then you can see the quantitative easing and QE1 and QE2 and QE affinity all the way through 2014. And then obviously we were starting to taper back right after 2018. We got a couple years of that, maybe a year and a half, and then boom, now we're gangbusters all the way up to $7 trillion. So we went from less than $1 trillion to $7 trillion today, roughly 8 trillion, 5 trillion. I mean, these numbers are just massive and we don't even really know what they mean. But I can tell you what they mean when this money gets out into the system. It's going to mean that the money that's in your pocket is going to be worth a lot less. And we already start seeing that. So let's talk about inflation, because that's what it is. And these are the official numbers. Where do we get these numbers? Well, we get them from the Bureau of Labor Statistics. Okay, great. It's up to you if you want to believe them. I don't believe them. And why don't I believe them? Well, because we've changed the formula twice. There was a formula that we had in 1980, okay? And then we changed it again in 1990, and then we changed it again. And why do we keep changing the numbers? Well, we change the numbers because we don't like what they're telling us. They're telling us we're having massive inflation, and we don't like that. But I want you to do yourself a favor. Write this down. There's a website called shadowstats.com. Don't do it right now, or maybe you want to. Google that. And this guy, John Williams, is reporting the numbers that the Bureau of Labor Statistics used to use. And I just looked it up. If you look at inflation today, it's really more like 7%. It's dropped from where it was, but it's about 7%. And so, the rule of 72 says that in every 10 years, your money's going to double at 7%. Well, in every 10 years, your value's going to cut in half at 7%. So look at where stamps were in 1965. They were a nickel. Today they're 50 cents. Unemployment. Same thing about unemployment. Go to that site, shadowstats.com, and there's the way we used to figure unemployment. Today's official numbers were at 14%. The way we figured it back in 1980, we're closer to 30 or even over 30. We just count them differently. Part-time workers, underpaid workers, underemployed workers, all kinds of different things. This chart shows the sort of a relationship between wage growth and the unemployment rate. And it makes sense because it's kind of inverse. Obviously, the lower the employment goes, the higher the wage growth goes, because of supply and demand. So you have a larger demand for wages, or a larger demand for labor, your wages would go up because of the supply would be relatively consistent. So that just makes sense. But again, unemployment is a real problem. Again, I think obviously when this virus is over and maybe there's a vaccine, I think there's a lot of pent-up demand. There's a lot of pent-up demand, and I think we're, depending on how things go, there could be an explosion in a good way. Consumer sentiment, you know, the University of Michigan, go Ted, right? University of Michigan, Ted Rising went to University of Michigan, and so he was on the diving team, and so he's a big Michigan guy, like Tom Brady. But the University of Michigan, every few months, calls like 500 people, I guess just randomly around the country, and asks them how they feel about things. And you can see that the sentiment moves relatively consistently with the moving average, but obviously it's just dropped off pretty precipitously there. What does that mean? Well, that just means people don't feel so great about spending money. And well, it's hard to, if you can't go to the mall, or you don't want to go to, you know, your Saks Fifth Avenue, which filed bankruptcy. Existing home sales. So we can see where residential real estate has dropped off considerably. And again, I think that has to do with the fact that, you know, you just can't really, don't feel like driving around looking at houses, especially other people's houses that still have furniture in it. And no one wants, you know, with the social distancing, it doesn't really make a lot of sense. But I do read that that's recovering some. Debt payments in a percentage of income. So this is household debt. This is the average person like you and I, and you know, what do we have? I can tell you that I paid off my student loans last year. That was a massive accomplishment for me. But household debt to the service ratio, you can see that in 2007, we kind of hit that all-time high there at 13%. And then now we're down, well, at least at the end of the first quarter, we're down to 10%. That's probably going to go back up, because I know people have had to depend on some credit to help get through this. And I think that's probably going to continue. And obviously, in terms of corporations, they're borrowing a lot of money too. Some of that's PPP, and that'll be forgiven. Obviously, you know, one of the things that has always driven the markets and always continues to, and it makes sense, is earnings. So how profitable is a company? And when you're buying a stock, you want that stock to return to you. You want it to return dividends, and you want it to return capital appreciation. And the way you do that is you have earnings, positive earnings. And so, you know, this chart sort of moves along with it. The blue is the price of the stock. That's the S&P, and then the purple is the earnings per share. And you can see that it pretty much follows. You know, there's dips in the market prices based on geopolitical events, whatever it may be. You can see that big dip right there at the end of 2018. You know, remember that was the midterm elections when the Democrats took the House. The Dow dropped 19% because of that. And so, you know, we have to kind of consider what this next election is going to be like, and the outcome of that, and what maybe could happen. I don't know what's going to happen. You know, I don't think you do either. I don't think anyone does. And so all I say is, you know, just remember Brexit, and it could go either way. But I can tell you this, I mean, if the corporate tax bill is repealed, you know, and corporate taxes go back up, I can't imagine that's going to be a good thing for stock prices, because the earnings are going to be less. Your net earnings are going to be less, because taxes are a big piece of that. And again, potential headlines, things could change. I mean, things can, we know how fast things can change. We saw it in March. I mean, again, there's several companies I read that have treatments going on, vaccine happening in the third phases of treatment or testing. Again, the election's coming up, that could go either way, and you know, all kinds of things could happen. If the Republicans take the House back, theoretically, you would think that would be a boom. Again, I'm neither Republican or Democrat. I have to try to walk the fence here, but I can tell you that the market doesn't seem to like taxes, and the Democrats seem to like taxes. So that just is kind of the way it's been for a while. So let's look at the second half and what's out there. What do we think might happen? What could happen? These are what we call strategists. There's different strategists out there. There's bottom-up strategists, top-down strategists. We're actually kind of both. We like to do a top-down first, which is like a macro perspective. What does it look like out there in the world? What's happening with interest rates? What's happening with oil prices, gold, all these other different things, the economy, you know, the political spectrum, geopolitical. Are we going to have another trade war with China, et cetera, et cetera? So those are macro things that we look at. Then I unleash my secret weapon, which is Blake, and he goes in and takes a look at things from the bottom-up perspective. So what actually are we going to invest in? Now that we know what we think is going to happen from the macro view, what are we going to do and what are we going to actually invest in? So for instance, when this thing hit, none of our clients had junk bonds, none of them, because we knew, we felt, and we were right, that that a lot of those bonds were going to take a hit, and they did take a hit. We didn't expect the virus, and we didn't expect $7 or $8 or trillion worth of bailout from the Fed, but that's what happened. Those things did take a hit, and they did lose value. They were downgraded, but the Fed stepped in and is buying them up. So we didn't have any of those junk bonds because that was a micro perspective. That was a bottom up. But we like to do top down first and then bottom up. We probably don't really care about that, so we'll let it go. Change in real gross domestic product. So we can see that, you know, actually moving along there, 2015 through 2019, everything's kind of moving at roughly about 2%. And then we had a big drop in 2020, down maybe negative 10%, which honestly is not that bad considering we almost had a complete shutdown of the economy for at least 2 or 3 months. And I can see that now the traffic in Atlanta is getting back up to where it was, which I guess is good in a way. I'm not sure. It was a ghost town there for a few weeks. I'll tell you, it was very strange. Corporate profit. So again, this is one of the big things that investors look to whether they're going to buy a stock or not. You can see a lot of stocks, especially in the tech sector, have been driven up because the tech sector is the only sector that really wasn't injured so badly. But everything else got hit. Obviously, retail and the cruise lines, the airlines, just terrible hit. And you can see the profits here have certainly dipped. But I feel like there's a lot of pent-up demand, and I feel like this could turn on a dime if we get a vaccine that really works and everybody gets vaccinated, and then, you know, boom, we're right back at it. We'll be looking at this in 4 or 5 years, and we probably won't even remember it. I'll remember it. Okay, so for short-term rates, what's ahead? I mean, this is when the Fed is meeting. They're meeting, you know, September, November, December. What are they going to do? They're not going to raise rates. Are they going to lower rates? Well, we're at 0. Are we going to go negative? Well, we got 3 more meetings. They'll probably just sort of sit back and say, hey, you know, everything's sort of stable and no need to do that, because I think going negative is going to be really, really negative. And I think that there's still some calls to audit the Fed. I mean, and I think after this, especially when inflation starts really kicking in, people are going to start complaining, and I think there could be concerns there within the Federal Reserve System themselves of their own autonomy. And I think that that's one of the reasons they're going to try to stay away from negative rates as long as possible. One thing that happens with bonds, and people get confused about this, because you could, you know, if you turn on CNN, they can say, okay, hey, terrible day today, the Treasury market, bond prices soared, or they can say bond prices collapsed. Well, it depends on how you want to spin it, right? If I've got bonds and the bond yield goes down, that means the price goes up. So if I have a lot of demand for a bond, the price of the bond is going to go up, because that's how supply and demand works. When the price of the bond goes up, the yield on the bond goes down, and vice versa. When the market dropped back in March, there were some bonds that dropped like maybe 30, 40%. Not me, but some other people bought those up because the yields were 14, 15, 20%. Now the Fed has gone in and bought those, and so those people feel pretty good. They're solvent, but it was very risky. But if they got bailed out, it made sense because now their bond prices are back up and they're still getting that huge yield. So good for them. But that's the way bonds work. And so, you know, you can watch TV and they can spin it either way. Treasury yields have dropped, which means the price of treasuries went up. Well, why would the price of treasuries go up? Well, because the stock market probably dropped and people wanted to sell their stocks and go into something safe. So you have to be careful of the spin. And you want to stay focused on the fundamentals. And that's one of the things. I mean, you know, listening to rumors, listening to your friends at work, listening to other people, listening to your family members. You know, you don't want to do those things. You don't want to listen to the news. You don't want to make financial decisions based on the news. That's the last thing to do. Because if you look at, here's the last 20 years. Well, no, the last 30 years. So if you look at this, since 1980, well, last 40 years. If you look at the last 40 years, almost every single year the market has been down at some point. So the little red dots was the intra-year low point. And then the blue is where the year actually ended up. So if you look at 2008, the lowest that it went was negative 49%, but it actually ended up only down 38%. If you go back to, let's go all the way to the beginning of 1980. In 1980, the very first year, it was down 17% at one time, but then ended up the year at up 26. So you can see that in almost every single year, there's a down point. Almost every single, and some of the years you end down. But in all these years where you have down points, a lot of them you end up positive, you see? And so that's one of the reasons that you've heard that adage, it's not about timing the market, it's about time in the market. And that, in a lot of ways, is true. If you look at just staying in the market for the 6 of the best 10 days, okay, 6 of the best 10 days occurred within 2 weeks of the worst 10 days. So this is the last 20 years, essentially. If you had $10,000 and you invested it back in January 3rd, 2000, and at the end of December 31st, 2019, you know, not taking into the 6 months of this year, because we're right back where we started, so it would be the same. If you had missed the first 10 days, if you had missed the best 10 days, excuse me, if you had missed the best 10 days out of that 10-year period, your return would have gone from 6% to 2.4. If you had missed the best 20 days, you would have gone from positive to basically flat out of a 10-year period. So out of a 10-year period, the best 20 days are what drove all of the return. 20 days out of 10 years. So if that's not an argument for staying in and not trying to time the market, I don't know what is. Facts are facts. Any questions from anybody? Let's see if I know how to do this. I have a couple of questions here. Okay, John Genlick writes, what happens to the market if the Dems win in November, and what happens if the Republicans win in November? John, I think, again, I'm not a political person. I try to stay out of it, but I just am an economic person, and I'm factual and logical and rational. Based on what has happened in the past, when the Dems have taken control, or at least in the recent past, we know what happened a couple years ago when they took the House. We were down 19%. There wasn't really other economic issues that would have caused that. So I think, I hope I'm answering this correctly. Okay, I think I am. I think that if the Republicans win the House and Trump wins, I think the market's going to go up. If the Democrats take over, I think the thinking will be among investors, they're going to be nervous because the markets don't like uncertainty. And the great uncertainty would be if the Democrats take over, that corporate tax break will go back. You know, instead of 20%, will go back up to 35%. And that's going to be a large tax on earnings. So I think that's going to, I think it's going to come down to that. I think that's what investors are looking at, the corporate tax rate. If the Democrats get in, that's the assumption that the corporate tax rate is going to go back up. If the Republicans keep control, the assumption is the corporate tax rate will stay in place. Okay, so Earl, good to see you, Earl. Earl has a question. Your debt to GDP prediction is 150%, but the Fed debt has gone from 2 trillion to 5 trillion, 6 trillion, yeah, 7 trillion actually. And the GDP is currently down about 32%. How do I justify debt to GDP of only 150%? Well, because I think, Earl, that's where it's going to shake out. I mean, right now we're all over the place. But I think, before we started this, we were at 100%. And our debt was 20 trillion. Okay. So, well, our total GDP is about 20 trillion. And so we're at about 100% of that. If we had another 5 or another 10, then that would put us about 150%. But yes, because GDP has fallen, currently it is out of whack. That's no doubt about that. But I think GDP will eventually get back to where we are. But the debt's not going away, right? GDP will come back, but the debt's not going away. And so when we sort of settle out, everything shakes out, we're probably going to look at about 150% of GDP, debt to GDP. And like I say, Japan's been running at 200%. I don't know where they are now. They're probably 220. But they have negative interest rates. And, Japan's had stagflation for 20, 30 years. So, hey, Ted, good to hear from you. Ted Rising asks, which market sectors look best for the next year? Well, that's a good question. We think a lot about that. And if you sort of think logically about what's happening, interest rates now are back down to 0, right? People who live on income, savers like you, are not working really, but you're depending on income. So you're going to be looking for things that provide income. It's not going to be CDs. It's not really going to be bonds. It's not going to be treasuries. You're going to be looking for income. So where are you going to go? Well, if you look at some stocks right now, they're paying really good dividends. I'm not going to say name names, but there's one big company that I know of, that all of you know of, that's paying a 7% dividend right now. Well, it has a lot of debt, but it also has a large market share. And so I think people are going to be looking for value stocks, and that's one of the places that we are putting money now, is value stocks. So value stocks doesn't mean they're a good value. They could be, but what it really means is they're paying dividends. And so Johnson & Johnson, Southern companies like that pay pretty strong dividends, and especially companies that have a history of rising dividends. I think that's where smart money is going to go. Great. Okay, so one other question. Back to Earl. Oh, another question. He hopes I'm right on the GDP. I'm right, Earl. It's going to come back. This is temporary. We're going to get back to where we were. Hey, Riley, good to hear from you. Because normally when we have a seminar, I always hear from you, and that's one of the reasons I don't like this webinar thing, is I don't get to joke with you guys as much and make fun of what you're wearing, or maybe you're sleeping in the front row. Is it part of Japan's problem due to their aging population? Yes, it is. They have a very aging population. In fact, Japan spends more money on diapers for the elderly than they do for diapers for babies. That is a problem. And if you look, Japan is they're very, what's the best word to say? They're very hesitant to let anyone in. They don't like new people coming in, and so they don't have a lot of immigration coming in, and then they don't have a lot of new births happening there. So that's going to be a problem here. Yeah, and of course, you hear about the baby boomers, and you always hear about now the baby boomers are starting to age. But I just read an article the other day that says there's now more millennial voters than baby boomers, and you know how intelligent the millennials are when it comes to voting, right? They would have us dismantle our police force, and I don't know what they're doing. But anyway, anybody else have a question? I'll give you just a second. No? All right. Well, listen, everybody. Went a little faster than I expected to, but that's probably because I didn't get the usual interruptions that I like to get. And so I'm going to go ahead and sign off from here. If you have another question, my email, Kevin@Magellan Planning. Just shoot me an email. If you have any concerns, let me know. We're staying on top of it. We're here. Email us. You can call us. We're answering the phone. You should have gotten my most recent letter, sort of saying where we are, kind of 1 foot on, 1 foot off, because we just don't know which way this is going to go. I get a feeling that there's going to be some other drop. And if you think about what we're focusing in on right now, as an economy, as a world, we're all focusing in on a vaccine. Every day is about what are the new numbers? How many deaths today? How many new cases? I just read an article yesterday that says that we just had the lowest new cases, in weeks. So, okay, that's positive, but we're still having new cases. So here we go. We'll just have to see how it goes. I just want all of you to stay safe. Hopefully you had a chance to spend time with your family. Maybe that's a good thing. Maybe it's not such a good thing. I don't know. I don't know with Riley, Meredith, if you're having a great time, but maybe keep him downstairs and let him play with this train set. But for all of you, we really appreciate you. We're here for you. Please let us know. And we just see, I maybe had one more question come up. Oh, thank you. Okay, so Earl says, thanks. It was almost as good as the in-person events. Well, that's great. I appreciate it. The good news is that we've had more people on here than we were able to stuff down in the conference room, the classroom. So we'll probably be able to do these again. I don't like it, but it's not that bad. So I hope you enjoyed it, and I hope it was helpful, and I hope I get to see you in person, not too distant future. So I hope you have a great day, and stay safe. Take care. Bye.